Hello, Namaskar. I am Sangeeta Sarpal, PGT Economics from JNV Patiala. The topic for today is national income and its aggregate. National income is one of the important topic of 10 marks out of the 40 marks of the macroeconomics. So you can think how important it is. So let us start with the national income. No doubt it is a very technical topic, but it is very simple to understand when we thoroughly study it. So the first topic in this is macroeconomics. The macroeconomics is that economics in which we study the economics as a whole. For example, when we study the national income of a country, population of a country के बारे में study होता है, poverty of a country, unemployment of a country, balance of payment of a country, money supply of the economy, inflation rate in the economy. When we study a components which is related with the full economy, then it is called as macroeconomics. For example, foreign exchange reserves of a country, import and export of a country, population of a country, anything which is related with the full economic status, full economy of a country, then it is called as macroeconomics. So macroeconomics is different from micro. In micro we study the minor components, whereas in macroeconomic we study the components which is related with the whole country. I hope you understand. The next concept is the consumption goods. The consumption goods are those goods which are directly used for the satisfaction of the human wants. Consumption goods are those goods which are directly used for the satisfaction of human wants. For example, when we eat bread, butter in the morning, these are the consumer goods. When we use clothes, shoes, these are the semi-durable consumer goods. When we use TV, bed sheets, fridge, then these are also the consumer goods, but these are the durable consumer goods. So consumption goods are those goods which we satisfy, with which we satisfy our wants. Consumption goods are those goods which are directly used for the satisfaction of wants. So the consumption goods जो हैं which definitely satisfy our wants. Next one is the capital goods. Capital goods are those goods which are used in the process of the production for the several years and it is of high value. Capital goods are those goods which are used in the process of the production. For example, plants, machinery, buildings, these are used as the capital goods. Capital goods are used by the producers and its repair is going on of time to time, then these are the capital goods. For example, Caesar Kenchi, it is a capital good because it is used by the producer, then it is a capital good. So capital goods are those goods which are used in the process of the production for the several years and it is of the high value. For example, plant, machinery, building, etc. Next one is the final goods. Final goods are those goods which are finally consumed by the consumers or by the producers. Final goods are those goods which are finally produced by the consumer. For example, bread, butter are the final goods for the consumers. Bed sheets are the final goods for the consumers. So also there are final consumption, final goods for the producers also. The goods which are finally purchased by the producers as a fixed asset, these machinery, these are the final goods because no value is added to the final goods further by the producers. तो producer goods के लिए, for the producer goods, final goods are those machinery which is used in the production process but no value is added to the fixed assets, then it is called the final goods. I again repeat, final goods are those goods which are used by the consumers and which I know it because these are finally consumed by the consumers. And for the producers, it is the goods which are used and purchased and used by the producers themselves as a fixed assets. For example, machinery is a final good for the producers. Next, intermediate goods. Intermediate goods are those goods which is used as a raw material to make a product. For example, wood is used to make a chair. For example, besan is used by the shopkeeper to make laddu. For example, cream is used by the shopkeeper to make ice cream. These are the intermediate goods. You can say that intermediate goods is like money, but it is used as a but intermediate goods are used as a raw material. So anything which is used as a raw material are the intermediate goods. Next, stock and flow. This is very important concept. It always come in the exam in the 1 or 2 3 marks. Stock is measured at a point of time. For example, money in your pocket at 11 a.m., water in a tank. These are the stock concept. Stock is measured at a point of time. For example, I have 500 rupees in my pocket at 11 a.m. So it is a stock. When the when the income is measured in a flow concept, flow is measured in a given time period. For example, the time period means from 11 to 11:30 how much money I have left. For example, I have money at 11 500 rupees and I gave some money to another person, rupees 200 I have given to another person. I have the remaining amount of 300. So it is a flow concept. When the time period is measured from 11 to 11:30, then it is a flow concept. For example, income, production, expenditure, these are all the flow concept. Income, production, expenditure, mm, anything which is measured in a given period of time, then it is called a flow concept. Whereas a stock is measured at a point of time. For example, money in your pocket at 11, water in a tank which cannot be disturbed, which should not be disturbed, then it is a stock. If it continuously flows, then it is a flow concept. So there is no a particular line between the stock and flow, but it is to noted that stock is measured at a point of time and it becomes flow when it becomes changes. So flow is measured in a given period of time and stock is measured in a point of time. Then this is called the difference between the stock and the flow. Next one is the gross investment and the depreciation. Gross investment is very easy to understand, very important to understand also. Gross investment refers to the total production of capital goods during one accounting year. Gross investment जो है, investment means investment is the production of the capital goods during one accounting year. It includes capital goods which are used for the replacement of the existing capital stock, which is also called depreciation. When we replace our old machinery to the new machinery because of some issue, then it is called the replacement of the existing stock. It is also called the depreciation. When we replace the old machinery because some issues are arising in it and we find difficulty in printing material or in the output process, then we replace the existing the capital stock. It is called the depreciation. The depreciation is again of we have three types: normal wear and tear are there, obsolete machinery is there, and accidental damages appear in the machinery. So this is in this these are included in the depreciation. The gross investment includes the replacement of the machinery. Next I want to say that gross investment includes the new purchase of the new machinery, whereas the replacement of the old machinery. Gross investment includes the two components. Number one, purchase of the new machinery as well as the replacement of the old machinery, which you can say is called the depreciation. So gross investment is a wider term, whereas the net investment is the shorter, narrow term. Net investment does not include the replacement. Net investment includes only the new stock. Net investment includes only the new purchase of machinery, new machinery. Then it is called the net investment. Whereas gross investment includes the both depreciation as well as the purchase of new machinery. So gross investment is equal to net investment plus depreciation, whereas net investment does not include the depreciation. So gross and net is the difference of the depreciation. Gross investment और net investment में सिर्फ depreciation का फर्क है, because gross investment includes the depreciation and net investment includes the does not include the depreciation. So next topic is the circular flow of income. The circular flow of income. Circular flow means it is the flow of income from one person to another. The income of one person is the expenditure for the other. For example, when we purchase one thing from the market, when we purchase one biscuit packet from the market, when we purchase, matlab we have paid money to the shopkeeper. So expenditure of one person is the income of the other. It is called the circular flow. This is the flow of not only income but also the flow of goods and services from one sector to another. It is assumed that there are only two sectors in the economy. One is the household sector and another is the production sector. So circular flow of income is not only the flow of income, it is also the flow of goods and services from one sector to another. For example, producer produce goods and it flows into the household sector. For example, household households provide land, building to the factories. These are also known as the flow of factors from the household sector to the other sector. Further, we also understand the concept. It is circular flow of income. It is the flow of income from the one sector to another, not in only the form of income but also in the form of the goods and services. Next, I try to understand and try to explain the real flow. Now this one is the household sector and this one is the production sector. Household provide factor services to the production sector. Factor services like rent, interest, rent. Household sector provide land. Household sector provide land. Household sector provide capital. Household sector provide uh, labor to the production sector. Household sector provide land, labor and capital to the production sector, whereas production sector provide goods and services to the household sector. It is called real flow. It is a flow of goods and services from the one sector to another, whereas household sector provide factor services to the production sector. I hope you understand. Next, money flow. It is in the form of money. Money, it is in the form of money. For example, there are two sectors in the economy, household sector and the production sector. Household make expenditure on the goods and services, then that income flows from the household sector to the production sector. Household sector purchase goods and services from the production sector and then make payment to the production sector, as well as the production sector makes payment of the factor of services. Production sector provide payment to the household sector. For example, rent is paid by the production sector to the household sector. Wages are paid by the production sector to the household sector. Uh, Interest is also paid from the production sector to the household sector. So these are called the money flow in the economy. Money flow means in the form of money, there is a flow from the household sector to the production sector and there is a flow from the production sector to the household sector. This is known as the money flow. Money flow arises when we purchase goods and services, then money flows from the household sector to the production sector. When household sector makes payment to its labor, take payment for the land, make payment to the factor services or labor or wages in wages की form में in the payment are done, then it is called the money flow. Next one is the methods to calculate the national income. We have three methods to calculate the national income. First one is the income method. Second one is the product method, which is known as the value added method. And third one is the expenditure method. These are the questions of the 6 marks we face in the exam. First one we do is the income method, and for the income method, for example, we have to make start from the income method. For to do the income method, we have to start from the payments. There are two types of payments. One is the factor payment and another is the non-factor payment. Factor payments are the payment in the form of the services. For example, a man gives service to another man in the form of a labor, then he get wages. So it is a factor payment. The factor payments are the payments which are in the form of the factor services. For example, a wages earned by the labor, rent earned on the land, interest is received on capital. These are the factor payments and factor income. Then there are also the non-factor payments. Non-factor payments are not in the form of the services rendered, but these are in the form of the grant, scholarships, in the form of scholarships, in the form of gifts. For example, when America gave gifts to the America gave gifts or donations to India, then it is known as the non-factor payments. Non-factor payments are not included in the calculation of the domestic income as well as the national income. So I repeat, factor payments are the payments in the form of the services rendered by a person. For example, wages are earned by the labor for his services, then rent is earned on land, and then interest is received on the capital. These are the factor payments, or these are also known as the factor income. So non-factor payments are the payments not in the form of the services rendered. The factor payments are the payment received not in the form of the services rendered. For example, uh, we get pocket money. We get pocket money from my parents. Then these are the non-factor income, non-factor payments. For example, I received gift on my birthday. These are also known as the non-factor payments or transfer payments. These are not included in the domestic income as well as the national income. So this is the explanation. Factor payments. Payments in the form of rent, interest, wages and profit. Rent is on land. Rent is given on land. Interest is given on the capital. Wages is given to the labor. Profit is earned by the entrepreneur. So rent is received from the land, interest is received from the capital, wages is received by the labor, profit is received by the entrepreneur. These payments are made for the services rendered or given. This is very important term. So the factor payments are the payments in the form of the services given, services provided. Another one is the transfer payments. Transfer payments are payments not in the form of the services, not in the not in the not in the not a payment for the services. The payments are not in those payments which are in the form of the scholarships, gifts, grant. These are known as the transfer payment. For example, pocket money by father to his son, scholarships given by the by the Vidyalaya to his students. Unemployment allowance is given by the employment exchange. Old age pension is given. Old age pension is also given not for the services. Gifts are given not for the services granted. Grants are given not for the services provided, but these are only economic help to the people for their services. These are not the payment for the services given. These are only the payment in the form of gifts and grant or as economic help. Then these are known as the transfer payments. So transfer payments are not included in the domestic income. These are not included in the national income. We do not enter it in the calculation of the domestic income as well as the national income. Now let us do the income method, some numericals. First one is the income method is very easy to understand. These are known as the factor income. Factor income are the rent, interest, wages and profit are the factor income. When we add these four components, we get the factor income. This factor income is also known as the domestic income. Domestic income is equal to rent, interest, wages and profit. So factor income is also known as the domestic income. This domestic income is also known as the net factor income. Net factor income. Net factor income. Net factor income is nothing. It is the net domestic income. Net domestic income is again the same thing, rent, interest, wages and profit. So factor income is also known as domestic income. It is also known as the net factor income or net domestic income. Net domestic product at factor cost and DP at factor cost is again the same thing, rent, interest, wages and profit. So now we first calculate net domestic product at factor cost to calculate domestic income from the national, and we calculate net domestic product at the factor cost. One, we calculate national income by the income method. First, we calculate net domestic product at factor cost. NDP factor cost is calculated first in the income method. Then we calculate. Let us do a simple question which is easy to understand. Calculate the domestic income. We add all these components. Wages is 50, interest is 70, interest is 10, profit is 55. Domestic income is rent, interest, wages and profit. We add these and we will get the domestic income. Find the domestic income and gross domestic income from the following data. Now we have understand the concept of net and gross. In gross, depreciation is added, whereas in net, depreciation is not added. So in this question, first we calculate the net domestic income. Let us see the components. Wages are given to us, profit is given to us, interest is given to us, depreciation, which is known as the consumption of the fixed capital, is given to us. Net domestic income we calculate. Net domestic income is wages, profit and interest. Here the rent is not given, so we will not consider it or assume it as 0. We will not consider it. When one component is not given to us, we will not consider it in the calculation. So net domestic income is equal to wages plus profit plus interest. We get 600. Then we have to find the gross domestic income. First, the income received is always net. Income received is always net because there is no depreciation in it. But the gross, in gross we add depreciation, gross depreciation, gross domestic income we add wages, profit, interest and depreciation. We get 350. We get 650 as the, we get 650 as the here we get 650 as the, we get 650 crore as the gross domestic income. So gross domestic income is the total of the wages, profit, interest and depreciation. You understand my point? We find the net, and then we find the first we find the net, and then we find the gross. I hope depreciation and the depreciation topic is clear to you. Next, national income. National income is calculated with the domestic income plus net factor income from abroad is always the added. National income is equal to domestic income as well as the net factor income from abroad is also added. This is the formula which you have to write for the minimum 10 to 20 times so that we may remember it. Next one is the domestic income. These are the basic components of the domestic income. When we write wages, wages does not mean only wages, wages include compensation of employees. Wages includes compensation. Compensation means and compensation means, just see, compensation of employees on operating surplus and mixed income. We also do the basic components of the domestic income by the income method. In this, we calculate net domestic product at the factor cost. In which we do net domestic product at factor cost. It is compensation of employees, operating surplus and mixed income. With the gross domestic product at factor cost, we add depreciation in it. So, net domestic product at factor cost is equal to compensation of employees, operating surplus, mixed income, and when we add depreciation in it, we get the gross domestic product at the factor cost. Plus depreciation is added. Supposing this is a question, calculate GDP at factor cost. We are to calculate net domestic product at factor cost and gross domestic product at factor cost. These are a simple questions. Compensation of employees is given to us 600, operating surplus is given to us 800, mixed income is given to us. The net domestic product at factor cost we are to calculate. We get compensation of employees, operating surplus and mixed income, we get 1440. And when we are to get the gross domestic product at factor cost, we add depreciation in it. So basic cheese, we have understand that we have three components of the net domestic product factor cost or domestic income. We add compensation of employees, operating surplus, mixed income, then we get the net domestic product at factor cost, and when we add depreciation in it, we get the gross domestic product at the factor cost. Components of the domestic income. There are also the components of the domestic income. First one component we have done, it is the first component we have done, which is the wages and salaries, social security contribution by the employers, and third one is the retirement pension. Wages and salaries in cash or in kind we receive as salary we receive as our employer, as a employee by the employer. Salaries we receive in the form of kind. When we eat dinner or lunch in the mess, we get the salary in the form of the kindness. Then is the social security contribution. Social security contribution by the employer. When the social security is given by the employer, then it is included in the compensation of employees. When the social security contribution is given by the employee himself, it is contributed by the employee himself, then it is not included in the domestic income. Next one is the retirement pension. Retirement pension is the pension which we get after the retirement, because these are the services rendered by the person when a person give the job years to a firm, then he get retired after 35 years of services, he get the retirement pension. So these retirement pension, wages and salary, social security contributions are included in the compensation of employees, and these are included in the calculation of the national income. Next one is the operating surplus. Operating surplus is a second component. Operating surplus include rent, interest and profit. Profit has again the three components: distributed profit, undistributed profit and corporate tax. I want to say one thing here. This is distributed, this is undistributed and this is the corporate tax. And these are the profits components. When once we add the profit as a component, we are nothing to do with the is further components. For example, when we add profit in our calculation, then we don't need to add undistributed profit, distributed and corporate tax. Now let me explain what is distributed profit. Distributed profit is the profit in the form of the dividend which is paid to the shareholders. Profit, the share of profit which is distributed to the shareholders, it is called the distributed profit. Undistributed profit is a profit share which is not distributed and which is retained by the producers to keep for the further investment. Then it is known as the undistributed profit. Corporate tax is a tax which is given by the firms to the government as a form of tax. So then the corporate tax is a share of profit which is paid by the producers to the government. Then next is the royalty. Royalty may be included in our question. Royalty may not be included in the question. Royalty is it is a grant given to another person to operate one function. So royalty may be included, may not be included in our question. The basic components of the operating surplus are rent, interest, profit, and then royalty. So this is very important. Mixed income. Mixed income is the income of the self-employed person. When you own one academy in your own house, it you are maintaining it, then it is called the mixed income. This is also paid for the services rendered to the other person, then it is also included in the calculation of the domestic income as well as the national income. Simple question for you. Calculate NDP at factor cost, gross net domestic product at factor cost and gross domestic product at factor cost. These components are already given to you. The components are compensation of employees, operating surplus, then is the mixed income, then is the we add three components, we get the net domestic product, and we add depreciation in it, we will get the gross domestic product at the factor cost. When we add the first three components, basic components, we get domestic income or net domestic product at factor cost. And when we add depreciation or consumption of fixed capital in it, we will get the gross domestic product at the factor cost. Next one is the value added method. This is another most important method. Value added method is the first step in this method is the value of output is equal to sales plus change in stock. Sales is the price into quantity produced by the producer. Change in stock is equal to closing stock minus opening stock. Value added. So value added is equal to value of output minus intermediate consumption. So this is the basic formula. This value added is known as the gross value added at market price. So gross value added or value added is one and the same thing. Gross value added at market price or value added is equal to value of output at the intermediate consumption. So gross domestic product at market price, it is also known as the gross value added at market price. It is also called, its formula is value of output minus the intermediate cost. Value of output minus intermediate cost. And when this is the gross domestic product at market price, and this is the value added which is related with the production. So it includes the depreciation. So gross domestic product at market price includes the depreciation, and when we are to make it net, then we have to deduct the depreciation from the gross. So gross domestic product at market price is the value of output minus intermediate cost, whereas net national product at factor cost is the gross domestic product at market price minus depreciation. When we depreciate it, we get net. When we get when we get depreciation deducted from the gross, we get net. And when we add net factor income from abroad, we get national. And when we deduct net indirect tax, we get the factor cost. So these are the basic formula in which we can say when we are to get net national product at factor cost or national income, we are to deduct the depreciation, we are to deduct the net indirect tax, and we have to add the net factor income from abroad to calculate the national income. So another question, find the net value added at market price. Now listen, we have to find the net value added at market price. And then first we find the gross value added at market price. Then we calculate the net by deducting the depreciation from it. So here is the solution also. Value of output first we calculate in the value added method. It is the value added is equal to value added is equal to value of output minus the purchase of the raw material. This gross value added at market price is called the value added, and after deducting the depreciation from this gross value added, we get the net value added. Next one is the find the gross value added market price. This is a simple question. We have given the sales, we have given the closing and opening stock. The purchase of intermediate consumption is also given to us. Purchase of machinery is also given. Subsidy is also given to us. Now let us see, the value of output formula remains the same. Value of output is equal to sales plus change in stock. Just see, the sales plus change in stock is also given to us. This is the gross value added at market price, which is the basic formula. The value of output minus the intermediate cost, we get the gross value added at the market price. Now is the expenditure method. Expenditure method, the basic formula of expenditure method again starts from the gross domestic product at the market price. Again start from the gross domestic product at market price. Private final consumption expenditure is added, government final consumption expenditure is added, gross domestic capital formation is added to it, and then net export is added to it. Private final consumption expenditure is the expenditure by the households. Government final consumption expenditure is the expenditure by the government on the purchase of uniform for his soldiers, on the purchase of food grains for the distribution purpose in the public distribution system. Gross domestic capital formation, it is the capital formation. It includes the purchase of new machinery as well as it includes the depreciation because the gross is given in it. It is also include net export. Net export is the export minus import. Gross domestic capital formation, it is the net domestic capital formation. Gross domestic capital formation, it is the net plus depreciation, but it is in the form of a fixed, so change in stock is also added in it. Gross domestic capital formation has three components again: net domestic fixed capital formation, depreciation, and change in stock. Net export is equal to export minus import. And then we have to find the national income. Net national product at factor cost is, we have to calculate, it is the national income. Then gross domestic product at market price, we add depreciation, we deduct the depreciation, we add net factor income from abroad, and we deduct the net indirect tax from the. Now this is the calculation of the GDP at market price, GDP at factor cost from the following data. When we add the basic components: private final consumption expenditure, government final consumption expenditure, and net domestic capital formation plus depreciation plus net export, then we calculate gross domestic product at the market price. Gross domestic product at market price we get, and when we deduct the net indirect tax, then we get the when we deduct net indirect tax, we get the gross domestic product at the factor cost. What is the definition of GDP? GDP is the gross domestic product at the market price. Gross domestic product at the market price. It is the market value of all final goods and services produced in one accounting year within the domestic territory of the country. It is the market value. It is the current value of the products, current value of the goods and services. Gross domestic product at market price. It is the market value of all final goods and services produced in one accounting year within the domestic territory of a country. Gross national product includes the net factor income from abroad, whereas the basic definition remains the same. It is the market value of all final goods and services produced in the economy in one accounting year within the domestic territory of a country, including the net factor income from abroad. So net factor income from abroad is a component. When we add in the domestic product, we get the national income, national product. Gross domestic product at base year prices or real GDP. It is the market value of all final goods and services produced in the accounting year within the domestic territory of a country at the base year prices. Any base year can be taken when we calculate the GDP, but the base years are fixed by the governments. The base year are already fixed by the authorities. Gross domestic product at base year prices, when we calculate price into quantity. If the price of the base year is 8, quantity is 200, we get the price into quantity, and we get the GDP at the base year is equal to 1600. Supposing we have to calculate gross domestic product at the market price. Market price is the current prices. When we calculate GDP at market price with the price into quantity. Price into quantity, we get the 3600. Which one is better for the welfare of the economy? No doubt, the welfare of the economy should be there. Supposing we calculate GDP at the base year. Just see in this is very important to understand. For example, when the GDP at base year is calculated, it is price into quantity, 10 into 200. Prices of the base year are the 10. The GDP at base year becomes 2000. When the GDP is calculated at the current prices, the price remains the same and quantity increase. When there is increase in the quantity at the GDP at the base year, from the base year to the current prices, then there is welfare of the economy. There is welfare of the economy. So the GDP at the base year or current prices, when the prices remains the same and quantity increase, there is welfare of the economy. But what happen in actual? Actually, if the price increase and the quantity do not increase, this reduces the welfare of the economy. GDP at the base year prices and real GDP are the best indicator. These can be the best indicator for the economy, because at the base year prices, when we calculate, it increase GDP at the basic price increase, it means the prices remains the same and there is increase in the quantity of output. When the quantity of output increase, no doubt there is welfare in the economy. The last concept in this GDP deflator. In this we calculate the GDP deflator as nominal GDP upon the real GDP into 100. We are given as the nominal and real. We can calculate GDP deflator like as while applying the formula nominal GDP upon the real GDP into 100. Now the GDP deflator and the price index, the formula remains the same. Price index is equal to nominal income upon real income into 100. When the price index is given, real income is given, how you can find the nominal income? You can easily find the nominal income when the other two components are given. The last one is the green GDP or green GNP. When we calculate GDP and we keep in mind our environmental pollution or the cost in terms of the excessive exploitation of the natural resources, then it is called the green GDP. While calculating the GDP or GNP, when we take into account the environmental issues and there should not be the excessive exploitation of the natural resources, then the GDP is calculated keeping in mind these two issues, then it is known as the green GDP or green GNP. So thank you very much of this audio. This is for the first time I am doing the same thing. Thank you very much.